Welcome to the B.F. Anderson Techno Fundamental Report for June the 8th. Interesting book, Psychology of Money by Morgan Housel. He states in the book, and it basically says that they did a study, this study right here, which is J.P. Morgan, called Eye on the Market, Agony and the Ecstasy. And it was a 25-year study that he referred to in the book that evaluated 3,000 stocks over 25 years from 1980 to 2014, which encompassed, one bull market and two bear markets and then another bull market. So it was a real good time period to do the study. Now, basically, 40% of the stocks lost at least 70% of their value and never recovered over this period. So you can see here the catastrophic losses by category, and the higher the return, the more chances of loss. And then it goes on to say effectively all the index's overall returns came from 7% of the companies. So it really makes a very good point about buy and hold. In some cases it works and in some cases it doesn't. We'll talk a little bit more about that. Another book called The Outsiders, about 8 unconventional CEOs. The way they determined the CEOs to write about was interesting. It says you really only need to know 3 things to evaluate a CEO's greatness: the compound annual return to shareholders during his or her tenure, and the return over the same period for peer companies and for the broader market, usually the S&P. So the way the author of the study determined the great CEOs was by the performance of their stock. So momentum, price momentum, volume momentum, this is all very important. So kind of back to what we were talking about originally in this study, where you had 40% of the database fail. You have to then realize that what's going on here is things change. The railroads, Enron, Enron was an interesting case. But anyway, buy and hold works some of the time, but when it doesn't, it can be catastrophic. So you really can't be complacent. Things change. The automobile came along, the railroads went out, the airlines came along, the railroads, the passenger rail industry failed. And you needed, as an investor in those stocks, you needed to be aware of the change. Just like the computer industry. Look at here, IBM in the old days, and you had finally you got a desktop, things just change. Now, kind of on the buy and hold subject, I thought this was an interesting quote. It said, Warren Buffett dumped PetroChina in 2007 when he decided circumstances warranted selling. Does that make Buffett a market timer? IBD chairman William O'Neill held Pick and Save for 7 years. Does that make him a buy and hold guy? The point is, you take it one stock at a time, you deal with it every day, and it's either a hold or it's not. And buy and hold, it can be a very devastating practice if you just close your eyes when you know you're wrong. Now, I thought it was interesting that we're hearing so much talk about recession. And it's all based on the fact that one of the reasons is that the yield curve is inverted. And we hear about it. Well, the economist that invented the indicator has basically come out and said that he doesn't think it's going to work anymore. And the reason really is, I said, one of the reasons is precisely the fact the yield curve relation has become so well known and widely covered. So in other words, what I have found about some indicators, and a point about indicators is that it's nothing more than an observation. You shouldn't look at an indicator and say, hey, this is predicting the future. Just take it into your computer, into your mind, and just weigh it. So basically, I'm not so sure we're having a recession. Here we have the real personal income, excluding current transfer payments, hit an all-time high. So, when you get back here and you look at the recession back in 2008, this doesn't look like that. And then here's the COVID recession, and this just doesn't look like that. So, we all deal with fear, and we all deal with fear of recession and all that, but you got to take this a day at a time. And right now, we are not in a recession. We could be, a week from now, we could be in a recession, or we could be in a recession 2 years from now. You just can't predict these things. Now, let's observe some indicators. Here's one that I think is important. There's been a change of character in the market, and I will say a positive change. This is new lows on the NASDAQ minus new highs minus new lows. We just got the highest reading we've gotten since the banking crisis. So we're starting to see the market broaden out. It's starting to broaden out, and you can see it very clearly with the small cap index. I think this is really an important change of character here, because the small caps, which does have a lot of banks in it, we'll look at the bank stocks, but you can see here that the small caps have been just in a downtrend, and all of a sudden, boom, we break out above all the moving averages and above the 200-day. This is a very positive sign, but it's just an observation. Another observation would be the volatility index, the VIX. It's hitting the lowest level it's hit in 3 years. So there's something going on here. There's some kind of change underway. Now, this is one of my favorite indicators that I like to observe is the aggression index. It's turning up, so it's telling you that investors are becoming more aggressive is what the bottom line is. Here's the bank stocks. We're seeing, again, another change there. You can see came down, vacillated, consolidated, firmed up, broke out. So it broke out over the last 2 days. So the bank stocks, if they get out of trouble, we're going to be in a much better shape. Now, all the new technology we're hearing about on the artificial intelligence, I know it's on everyone's mind because it's in the media all the time. This is a graph of NVIDIA. Now, you can see here for months, it's just been really a nice, steady uptrend. And then all of a sudden, they announced their earnings, which we're going to look at here in a minute. Gap up, and then it's now consolidating. So my advice on this only technically would be, if it fails to hold this 360 area and break down below that base, I think I would wait. I would definitely wait. I would wait for this stock to finish this consolidation and either break out to the upside or break out to the downside. If it breaks to the downside, sit tight, let it consolidate, and then break out again. So I would watch this closely, but I think right now, technically, this is a hold situation. Now let's just look at the fundamental numbers real quick. Now this is as of their most recent quarter. Very healthy profit margin. Very, very nice. Nice. Return on equity, excellent. Positive cash flow. They've got cash of $15 billion on the balance sheet. They've got $12 billion debt, but you got $15 billion in cash, so that's not a problem. And then their current ratio is 3.5 to 1, which is excellent. Now, realize here on their quarterly revenue growth was negative. However, their earnings were positive. So it looks like they've basically have kind of completed an R&D expenses cycle, and that's one of the reasons I believe that their earnings have turned positive, because they've got a new product and it's pretty much paid for. So if you have any questions, give me a call. Thank you very much.